This video is all about journalizing transactions. So we are going to start with vocabulary, and then we're going to talk about source documents. We'll go through 10 example transactions, and then we'll finish up with standard accounting practices. So here we go with page 1, vocab. So a journal is defined as a form for recording transactions in chronological order. That means by date. And journalizing is the action of recording transactions in a journal. And an entry is info for each transaction recorded in a journal. General journal is defined as a journal with 2 amount columns in which all kinds of entries can be recorded. You can see an example of our general journal page 1 here, and let me walk you through what each column means. So first up, we have the date. Then we have the account title. And each entry affects at least 2 accounts. So one journal entry will have 2 or more account titles listed there in that column. DocNo stands for document number, and this is in reference to the source document, which we're going to learn more about on the next page. And then PostRef stands for post reference, and this is all about posting to the ledger, which is in the next set of visual notes. So we'll learn more about that next video. Then we have our debits and credits, and this assures that debits equal credits for each transaction. So you'll have 1 debit, 1 credit. It'll be the same amount. Sometimes there's more than 1 debit or credit, but that comes later. So for now, for this set of notes, it's just going to be 1 debit, 1 credit, and it'll be equal amounts. Now, double entry accounting is the recording of debit and credit parts of a transaction. And so that's what our general journal is doing for us. Down at the bottom, we have a few more details about the general journal here. It is a chronological record, meaning it's recorded by date, and it's beneficial because it's all in one place and it's easy to locate. Also, in terms of accuracy, it includes debit and credit parts in one place, and info can be verified by comparing it to transaction data. So all of these steps, all through the accounting cycle, they are all linked together. So you can see our source document is included on our general journal, and that's where the paper trail starts. So it comes from our source document, and then the post ref is where it's going. It goes to the ledger. So again, they're all linked. And now moving on to page 2, which is about source documents. So at the top, we have an accounting concept called objective evidence. And what this means is that each transaction is described by a source document that proves that the transaction did occur. So accounting is all about following the paper trail, and it is all about making sure that things are accurate. Source documents is where the paper trail starts. It's defined as a business paper form which info is obtained for a journal entry. It must be accurate. And here are some examples of what source documents are. First up, we have a check. This is a business form ordering a bank to pay cash from a bank account. A check stub is prepared at the same time, and the check stub is what the business keeps, and that is their source document. These are source documents for cash payments. Now, remember, when we say cash, it's not a stack of money on the business owner's desk. It is an account balance, a checking account balance. So a check, makes sense then, is a source document for cash payments, meaning payments made out of the checking account. The next type of source document is an invoice. This is defined as a form describing what was sold, the quantity, and the price. It's sometimes referred to as a sales invoice, and this is the source document for services sold on account. So when you sell something to someone, but they do not yet pay for it in cash, they get an invoice. Next, we have a receipt, and this is a business form giving written acknowledgement for cash received. This is the source document when cash is received from sources other than sales. So, for example, an investment. A receipt is the source document for an investment. Next, we have calculator tape, and this is a printout of the total amount of cash received from sales that day. It's the totaling of all individual sales, and then one source document is used for many sales. Again, this is the source document for daily sales. We say calculator tape. The truth is that these days it's more of a computer printout. So if you have a point of sale system where you take customers' cash payments throughout the day, instead of it being a calculator tape that's adding up as it goes, it is a computer printout. But the same idea applies in that it accounts for all the daily sales. Lastly, we have a memorandum. This is a form on which a brief message is written describing a transaction. This is the source document that is used when no other source document is prepared for a transaction or when there's additional explanation needed. So it is numbered just as checks are numbered, and it's a formal paper, but it's kind of a catch-all. It does the job of a source document when nothing else applies. So memorandum is the catch-all. Next up, we have 10 example transactions on pages 3, 4, and 5. On the top of page 3, we see that journal entries consist of 4 parts. The first part is the date, and for the first entry on the page, you include the year, the month, and the day, and then the rest of the entries, you just include the day. Second is both the account title and the amount for the debit. Third, same thing, but for the credit. It's the account title and the amount. And lastly is the DocNo. Now, this stands for the source document number, and it's a cross-reference from the journal to the source document, and it's included so that more details about the transaction can be found if necessary. Remember, all the steps are linked together, and this links the source document to the journal. For transaction number 1, on April 1st, we received cash from the owner as an investment for $2,000. Now, at the beginning, the first on the page, remember, they include the month and the year along with the day. Then debits are first. And if you need to do the T accounts, please do those as long as you need to. If you don't need to do the T accounts and you know which one is the debit, then you can just go ahead with the account title and amount. But we know receiving cash is an asset. Cash increases on the debit side. So the cash is going to go first. Cash, $2,000. You'll also notice that the columns there in the debit and credit columns separated little columns in there, and those are to keep your dollar amounts aligned. The column under debit that is furthest to the right is for cents. So the 00 in the same little wider column there, that's for cents. So it's $2,000.00. Then we have our credit title. And when we have an investment, it's the owner capital. So credits are second and indented, and our owner's name is DONA. If you don't know what that is, you can look up in the chart of accounts. But we've got our capital account, and then over in the credit column, we've got that $2,000. And our last step there is our document number. It is R1. R stands for receipt. You can see our little repeat image there for receipt. Don't forget to fill that in last. Your source document number in the DocNo column, R1. Transaction number 2 says on April 2nd, we paid cash for supplies for $300. And you'll notice that those rows are numbered. So the first transaction was on row 1 and 2 of page 1 of the general journal. Now we're on pages 3 and 4. And because it's the second transaction, we only need to include the date, not the year or month. It's understood that it's April, and the year is understood because it's above it. Now we just need to move on to the debits and credits. So paid cash for supplies. Both are assets. Supplies is the one that's increasing. So supplies is going to be the debit in this case. We've got our $300.00. Then our credit is cash, $300.00. And then our source document is check. And you'll see our little image that represents check as a source document. And our check is C1. It's check number 1. On page 4, we have transactions 3, 4, 5, and 6. So transaction 3 says on April 4th, we paid cash for insurance. Now, this is very similar to paying for supplies. And so we're going to do a repeat of transaction number 2, but with the substitution, prepaid insurance for supplies. First up, we have our date. It is April 4th. So we have the 4th. Our debit account is prepaid insurance. Our amount is $600. And then similar to transaction number 2, we are paying cash. So cash is decreasing, which means it's a credit. We've got cash and $600. Don't forget to indent that credit. And lastly, we have our DocNo, or our source document number, and it is also a check. It is C2. For transaction number 4, this is April 7th. We bought supplies on account from vendor for $800. On account means we bought it now and we're going to pay for it later. So cash is not involved here. We did not pay cash. It is the 7th. We've got our date. And when we think about what account is debited, we bought supplies. That's an asset and it's increasing. So supplies is going to be our debit, and it is $800. And then our other account If you're not sure, look at your chart of accounts. Vendor is part of the account name. And if you look at chart of accounts, that should pop out at you as the account that you would use for any transaction that has the name vendor in it. So our account is accounts payable. It's a liability. We're going to have to pay them at a later date. So we've got our accounts payable for vendor. Our amount again is $800. And our source document for this one is M1, M standing for memorandum. There's not another source document that goes for this. So we're going to write a memorandum out that we bought supplies from them. It's M1. Transaction number 5 says we paid cash on account to vendor. So we bought those supplies on April 7th. Now we're going to pay part of that bill on April 15th. And so we've got April 15th there. Again, it's understood that it's the 15th of April in the current year because that was listed on row 1 of this general journal page. It's now row 9. It's understood that we're still in the same month and year, but we do have the date there, the 15th. Now, when we pay cash, that means our cash is decreasing and it's going to be a credit. So we know cash will be the second account. The first account listed here is that accounts payable to vendor. When we bought supplies on April 7th, our bill went up. Now our bill is going down. So our liability accounts, when we decrease a liability account, it's a debit. And this is a debit of $500. Again, do those T accounts if you need to. Do those for help as long as you need to. Our credited account is cash. And again, that's $500. And don't forget our source document. In this case, it's C3. You can see our little check picture there, C3. And notice that source documents go in consecutive order. So far we've used check 1, check 2, and now we're using check number 3, and they go in order like that. Transaction number 6, on April 15th, we received cash from sales for $300. So we're receiving cash. That means cash, the asset, will be debited. Cash will be first. So it's on the 15th. We've got cash. We've got a debit of $300. Sales, that's under owner's equity, and the business is smiling. So it's on the side you would expect. It's on the credit side. So we've got sales, $300. And our source document for this is T15. Now, I just said that source documents go in consecutive order, except calculator tape. That's the one that represents daily sales. That goes by the date. So you'll see this happened on April 15th. This is T15 for calculator tape on April 15th. Okay, we've got page 5 here where we're going to finish up our 10 example transactions. We're going to start with transaction number 7. You might notice on your printout, it might say August up there. That's a mistake. You want to cross that out and write April. If you have the updated printout already, then it should already say April there for you. But if it says August, cross it out. We're in April. You'll see that we're on rows 13 and 14 of our general journal. It's already understood that it is April, not August. It's April, and the current year is on there in row 1. So we're just writing the date, the 16th. And our debited account, when we sell services on account to customer, that's an asset. That's an accounts receivable account where they are going to pay us money, but they have not yet paid us cash. So it's an asset to us, the bill that they will pay, and the amount there is $500. And then sold services, that means we made a sale. So sales is our credited amount. It is indented there, and it's also $500. And then our source document is S1 for sales invoice 1. Transaction number 8, on April 20th, we paid cash for rent. So when we're paying cash, that means cash is decreasing, and that will be the credit. Our rent is going to be the debit. So it is the 20th. Again, it's April 20th. And rent expense is our debited account for $600 is our amount. Our credit is cash. And again, that amount is $600. And you'll see it is a check. We've got our little check image there. It is our 4th check. So it's C4. Transaction number 9 happened on April 26th. We received cash on account from customer, $300. And so we're receiving cash. That means cash is going to go up. That means cash is debited. So we've got the 26th cash. Our amount is $300. And then our credited account is the accounts receivable customer. So also an asset. It is decreasing because their bill is going down when they pay on it. So it's a decrease or a credit of $300. And the source document is a receipt, so it's R2. Our last example here, transaction number 10 on April 29th, we paid cash to owner for personal use. It was $100. So we've got the 29th. Our debit is DONA drawing, and it's for $100. And then, of course, cash is decreasing. So that's going to be the credit. Cash, $100. Our source document is C5. So it's check number 5. The owner wrote a check to him or herself out of their business account to their name, to their personal account. So it's a check, it's C5. So a journal page is complete when there isn't enough space for another complete entry. Debits and credits are not split between pages. So if you get to the end of the page and you only have one row left, but you need 2 rows for the entire entry, then you do not start it. You skip that last line and you go to the new page. And a new page is started just by writing the page number up in the top. So we finished General Journal page 1. Now we're going to General Journal page 2, and we number those pages so we know what order they go in. All right, we've got page 6. This is all about standard accounting practices. So errors are corrected in a way that doesn't cause doubt. You want to draw a neat line through the error and then write the correction just above the error. If you make a mistake, you don't want to pretend like you didn't make it. You want to make the correction so that it's understood that a mistake was made and it was found and it was corrected. If the entire entry is incorrect and discovered before the next entry, you can draw neat lines through each part of it and then write the correction on new blank lines. But if an incorrect entry is discovered and there are additional entries after that incorrect entry, you have to draw a line through each part and then record the correct info on the same lines directly above. You want to make sure that there are no doubts that it was a mistake and it was corrected. Words should be written in full when space allows. You only want to abbreviate when space is limited. All words should be written legibly. Of course, if you're doing this on a computer, then all words should be typed correctly. But you want to make sure that there's not any doubt as to which account you mean. So paper or computer, you got to make sure you're including as much info as you can, as neatly as you can. Dollars and cent signs, as well as decimal points, are not used when writing amounts on ruled accounting paper. So that's why we have those columns separating the dollars and cents. It's understood that that last column there on the right in those debit and credit columns of the journal, those are for cents. You don't need to write a decimal point there. It's understood that that's what it is. It was made to show money or dollar amounts. 2 zeros are written in the cents column when an amount is even dollars. You don't want to ever leave that blank because you don't want there to be a doubt about if it was the correct amount or what was the correct amount. So even when it's 00, you got to write that out. Neatness is very important so that there's never a doubt about what info has been recorded. So a ruler is even used to draw lines. You want to make sure that you're very neat and accurate. It should be clean and easy to understand. And lastly, here we have the accounting equation. So we're going to start here. It says, first up, we analyze transactions. Now, I've got my little coffee cup there because it goes back to that sort of breakfast motif on page 2 to show that that's where it all starts. You begin the day with breakfast and you begin your accounting cycle with analyzing transactions. So analyze transactions, then we journalize, which is what this set was all about, and then we post to the ledger. Then we prepare a worksheet and financial statements, then journalize and post adjusting and closing entries, and lastly, the post-closing trial balance. So more videos and notes to come. So far, we've learned about analyzing transactions using source documents and journalizing transactions using a general journal. So at this point, you can go ahead and return to previous pages, add more details, color code what you'd like. But I hope you found this helpful. Stay tuned for more videos. And thanks for watching.